Billionaires like Elon Musk or Jeff Bezos often receive no standard salary, which eliminates their exposure to the highest federal income tax bracket of 37%. Their wealth exists primarily in company stock, which increases in value over time. This growth is classified as unrealized gains and remains completely untaxed by the Internal Revenue Service. Under the current tax code, a taxable event only occurs when an asset is sold. By never selling their shares, the wealthy avoid triggering capital gains taxes entirely. To fund their lifestyle, the rich use their stock as collateral to secure low-interest loans from major investment banks rather than selling assets for cash. Loan proceeds are not considered income. When you receive $1 million from a bank loan, you owe $0 in income tax on that money. The interest rate on these specialized loans is often significantly lower than the 20% long-term capital gains tax rate or the 37% income tax rate. Financial planners call this strategy buy, borrow, die. It involves buying appreciating assets, borrowing against them for liquidity, and holding them until death to reset the tax basis.
When an individual dies, their heirs receive a step-up in basis. This means the taxable value of the asset is reset to the current market price on the date of death. If the heirs sell the asset immediately after the step-up, they pay zero capital gains tax, even if the asset grew in value by billions over the previous decades. Real estate offers a unique tax benefit called depreciation. The law allows owners to deduct the cost of a building from their income over 27.5 years. Depreciation is a non-cash expense. A property can generate positive monthly cash flow while reporting a technical loss on paper, resulting in zero taxes due on the rent collected. Wealthy investors use cost segregation studies to identify components like lighting, flooring, and landscaping that can be depreciated much faster than the building structure itself. In 2026, investors can still utilize 20% bonus depreciation to front-load their tax deductions and offset income from other sources. By qualifying as a real estate professional, an investor can use unlimited real estate losses to offset ordinary income from high-paying jobs or business ventures.
The 1031 exchange allows investors to sell a property and reinvest the proceeds into a new property while deferring all capital gains taxes indefinitely. Section 1202 of the tax code permits founders and early investors in certain small businesses to exclude up to 100% of their capital gains indefinitely. To qualify for this exclusion, the stock must be held for at least 5 years, and the company gross assets must not exceed $50 million at issuance. Small business owners use S corporations to split income between a reasonable salary and business distributions. Only the salary portion is subject to payroll taxes. The qualified business income deduction allows eligible self-employed individuals and small business owners to deduct up to 20% of their qualified business income from their taxes. A charitable remainder trust allows you to donate an appreciated asset, receive an immediate tax deduction, and still draw an income stream for life from that asset. Donor-advised funds allow the wealthy to take a massive tax deduction in a high-income year while distributing the actual money to charities over many future years.
Private foundations allow families to maintain control over their wealth and employ family members to manage the foundation, all while receiving significant tax breaks for the initial funding. A charitable lead annuity trust can pass assets to heirs with zero estate or gift tax by first paying a fixed income to a charity for a set term. Tax loss harvesting involves selling underperforming investments to realize a loss, which can then be used to cancel out capital gains from successful investments. To stay legal, investors must avoid the wash sale rule, which prevents claiming a loss if a substantially identical security is purchased within 30 days. The wealthy use Roth conversion ladders to move money from taxable retirement accounts to tax-free Roth accounts by paying taxes during low-income years. Employees at major tech firms often utilize the Mega Backdoor Roth, allowing them to contribute up to $69,000 annually into tax-free accounts. International investors use foreign tax credits to ensure they are not taxed twice on the same dollar of income earned in different jurisdictions across the globe. Act 60 in Puerto Rico offers a 0% capital gains tax rate for United States citizens who become bona fide residents of the island. High earners often move to states like Florida, Texas, or Nevada, which have zero state income tax, instantly increasing their take-home pay by up to 13%. Family-limited partnerships allow parents to transfer assets to children at a discounted valuation for gift tax purposes because the interests are illiquid and lack control. Because a minority interest in a family business cannot be easily sold, the Internal Revenue Service permits a lower valuation, reducing the ultimate estate tax bill. An intentionally defective grantor trust allows a wealthy individual to freeze the value of an asset for estate tax purposes, while personally paying the income taxes for the heirs. This setup allows the assets in the trust to grow and compound completely tax-free for the heirs, as the grantor is effectively making a tax-free gift by paying the annual income taxes. High cash value life insurance policies allow the wealthy to grow money in a tax-deferred environment and then borrow against that cash value tax-free for any purpose. The death benefit of a life insurance policy is generally paid out to beneficiaries completely free of federal income tax, providing a massive liquidity injection to pay estate taxes. Dynasty trusts are established in states that have abolished the rule against perpetuities, allowing wealth to grow and be passed down for generations without ever being hit by estate taxes. Investors can defer capital gains by investing in qualified opportunity zones. If held for 10 years, all new appreciation on the opportunity zone investment is 100% tax-free. Wealthy investors often use borrowed money to buy more investments. The interest paid on these loans can often be deducted as an investment interest expense to lower their overall tax bill. The federal corporate tax rate is a flat 21%. High earners often use corporations to retain earnings at this lower rate rather than paying the top individual rate of 37%. Private equity and hedge fund managers receive a portion of profits as carried interest. This is taxed at the lower 20% capital gains rate instead of the higher ordinary income rate. Qualified dividends are taxed at the same preferential rates as long-term capital gains. This allows wealthy shareholders to receive millions in cash distributions while paying significantly less than a doctor or lawyer. The United States Supreme Court has ruled that anyone may arrange their affairs so that their taxes shall be as low as possible. Tax avoidance is legal. Tax evasion is a crime. By reinvesting the money that would have gone to taxes, the wealthy utilize the power of compounding to grow their fortunes at an accelerated rate compared to those paying full tax rates. The path to 0% taxes legally requires high-quality assets, strategic borrowing, and a thorough understanding of the tax code to ensure every deduction and credit is maximized according to the law.